see, 4 people today. It's getting fewer and fewer. Maybe more will join soon.
No worries, they will come for sure.
Yeah.
Especially when the midterm is tomorrow, isn't it?
No, Thursday? No, wait. For you? Let's just check.
Yeah, I think it's tomorrow.
Midterm, June 3, 10:30. Starts, closes, yes. Yeah, tomorrow. Okay, let's start. Okay, so today we're going to be talking about managing cash flow. Okay. Okay, the importance of cash flow. Everything is about cash. Raising it, conserving it, collecting it. That's a quote from Guy Kawasaki. And Guy Kawasaki is the author of a book called Rich Dad, Poor Dad, which is a very good book. But also at the same time, I think Guy Kawasaki has declared bankruptcy, so he's still learning it himself. Common cause of business failure, cash crisis. And what that means is payroll is due and you don't have the money in the bank, or somebody is trying to get you to pay a bill and they're not going to give you any more inventory until you pay the bill, but you don't have the cash. Those kinds of things are a cash crisis. Okay, the goal of cash management is to make sure that the company has cash available when obligations must be paid. That means obligations are bills or payroll. A business can be earning a profit and be forced to close because it's running out of cash. Okay, can anybody tell me what that might mean? A business can be earning a profit and be forced to close because it's running out of cash.
Like capital?
Yeah, so it has no capital, it's run out, but it's still profitable. How is that possible?
Maybe their brand name?
No. Okay, so profit, and when you calculate profit, it's accounts receivable are also a part of profit. And accounts receivable is money people owe you but haven't paid you yet. So you don't actually have the cash, but it registers as a profit. So this is about your collections when you do sales, especially in commercial business when people don't pay right away. You can run out of cash. Okay. American Express, the credit card financing company, opened a small business monitor study. 57% of small business owners experience problems with cash flow. The biggest cash flow concern is the ability to pay bills on time. Okay, small business owners' rating of their company's cash flow. So this is likely US, American, but from 2003 to 2012. Green is somewhat or very good, their ability to manage cash flow, and red is somewhat or very poor. And just look at the trend line. 17 years ago, most businesses would have said it was very good, getting close to 70%. And by 2012, it was around 40%. Said that their ability to manage cash flow was very good. So, and a lot of these are economic based, so sometimes things outside of business's control. Okay, cash management, the definition. Okay, forecasting, collecting, disbursing, investing, and planning for the cash a company needs to operate smoothly. Cash is the most important asset of a business. Well, some people argue that your people are the most important part of your business, but without the cash, you can't have the people. Young and growing companies are often cash sponges. That means they just soak up, they take a lot of cash. All right. New businesses may take time to become cash flow positive. So the second line, young and growing companies are often cash sponges. They soak up a lot of cash. In your presentation, research, entrepreneur research, it talks about cash flow and a problem that entrepreneur might have had with cash flow. If you can't find something, Google things like the name of that business that entrepreneur started, and then early cash flow problems or things like that. Because what you'll find is they were never making money at the beginning, and their cash flow, they were just spending it as fast as people would lend it to them to grow their business. New businesses may take time to become cash flow positive. Okay, that means taking in more cash than they're spending. When businesses are growing, cash can be flowing out of the business faster than it flows in. Entrepreneurs must know their cash cycle, the cash flow cycle. The time difference between paying a supplier and receiving payment from the customer after the company sells a product or service. So again, if you're in commercial work, business to business, and your cash flow cycle, a client might hire you to do a construction job, okay, and they don't pay you anything right away, but you have to either hire or buy equipment, hire employees, incur lots of expenses until that client starts paying you. Okay, and that time from start to when you get your first payment is the cash flow cycle. Okay, and here's an example of a cash flow cycle. This is for, just say this is for a clothing wholesaler. Okay, so on day one, they order their clothing from a factory. Okay. On day 15, they receive the goods. Okay, but when you order from a factory often, and especially if it's in China, they want 50% of the money up front before they even start making the products for you. So you pay up front. 15 days later, and in China it could be 30 to 60 days later, you receive the product. But here, this example is 15 days. You pay your invoice for your product. That's 40 days out from ordering the goods. Then it takes 178 days to sell all your goods. Okay? You deliver those goods. So some retailers buy your shirts that you bought because you're a wholesaler. Okay, 3 days for the delivery. It says here you send the invoice 9 days later, and then 50 days later the customer pays you. So from the day you ordered the goods on your very first order to the point the customer paid you, when you start a business, you are in business for 280 days in this example. And this is very realistic, and this is why so many businesses fail. Okay, so the first asterisk under sell goods is based on average inventory turnover. So most companies do a turnover of 2.05, and that means they sell out their inventory 2 times a year. So say they sell 10,000 shirts a year, or they make 10,000 shirts per order. They would make 2 orders a year and sell 20,000 shirts. Okay, and the second asterisk under pay customers, based on average collection period. Okay, the average collection period is about 50 days. Okay, 5 cash management roles of an entrepreneur. Okay, cash management roles. Cash finder, they have to go and get financing to even start their business. They have to plan what they're going to do with the money. They have to distribute the money, the things they're going to buy with the money, and pay those invoices. Cash collector. So when they make their sales, they have to take the money and either put it in the bank or do something with it. And then cash conserver, they have to find ways to not spend so much money. Okay, cash flow versus profit. These are 2 different things. Cash flow is not the same as profits. Profit is the difference between a company's total revenue and total expenses during a specific period of time. Cash flow is the cash that is available for use to pay the company's obligation. So you actually have to have the cash. Cash flow measure a company's liquidity and its ability to pay bills. Okay, so liquidity is assets that are convertible within the year. Okay, cash flow, increasing cash. Okay, so things that increase cash are accounts receivable, and then you see this thing called leakage. Does anybody know what leakage is, or can guess what it might mean?
Like if there is a leak in something that can take off the bigger amounts of money.
Right. So
Like
what would be
taken
what would be an example for accounts receivable?
for accounts receivable after like paying something and then receiving the value of the thing.
Mm-hmm. And where would the leakage be?
The leakage would be if you're not receiving the value of it.
Right. So the full value. Exactly. So
Okay.
so say you sent out 100 invoices and one customer goes out of business. Okay, that's leakage. Or one customer calls you and says, "Listen, I know I owe you 10,000 reals. I only have 9. Will you accept that?" And there's a leakage, right?
So that would happen as a leakage in that scenario.
Yes. Poor accounting. So somebody forgets to enter an invoice. So there's lots of ways that you can have accounts receivable and you never get the full amount. Okay. Then there's cash sales. They go into cash. Things that decrease cash, accounts payable, and production cash purchases for inventory. Okay. And not in here, and don't worry about it, but other kinds of leakage occur, such as having an employee who steals some of the inventory. As you can see, the leakage down below inventory. So often it's your employees that steal the inventory, and sometimes it's customers that steal the inventory. So your inventory shrinks. So there's lots of things that you have to manage when you're running a business to manage cash flow. Okay, a cash budget. A cash map that shows the amount and the timing of a firm's cash receipts, cash inflow, and cash disbursements, cash outflow, the things you spend over time. It predicts the amount of cash a company will need to operate smoothly. Helps to visualize a company's cash receipts and cash disbursements and the resulting cash balance. Cash budgets can be prepared for daily, weekly, or monthly analysis. And now we talked about the amount of business, a lot of business or companies go out of business. If you don't do a cash analysis or a cash budget analysis, your ability to understand your cash flow is not going to be strong, and you're going to miss opportunities for saving money. And we're going to look at an example. Cash flow should be projected for at least 12 months ahead. Okay, preparing a cash budget. So there's 5 steps. 1, determine an acceptable minimum cash balance. Okay, a rule of thumb is 25% of liabilities. It may not be suitable for all businesses, just an industry average. Entrepreneurs should examine past cash requirements. Okay, forecast sales. Okay, sales are the heart of a cash budget. Sales are ultimately transformed into cash receipts and cash disbursements. Okay, cash receipts, so you make a sale, either it's going to be an accounts payable or you're going to get the cash for it. Cash forecast is only as accurate as the sales forecast from which it is derived. So this is creating the forecast or the budget. Your sales budget is going to determine the maximum amount of cash you're going to have. Okay, sales forecast. Lumpy or seasonal sales patterns are common. So lumpy, they mean one or 2 week period or a month could be really high in sales, and the next period very low in sales. Okay, example, 40% of toy sales take place in the last 6 weeks of the year. So in Canada and the United States, that's before Christmas. Okay, so think about for Qatar, for toys, when would be the peak 6 week period for toy sales? Can anybody tell me what that would be?
When children pass their exams.
Okay, so June. So June, and would June also be combined with Ramadan? Maybe do children get like Eid gifts? Like little children get toys and stuff?
Yeah, Eid gifts, yes.
And that's close. And this year, it's also close to the end of school, so it could be a very busy toy season when Ramadan is in June, or whenever the school ends. Okay. Cash management is even more important for highly seasonal businesses. Okay. What are highly seasonal businesses? What could be an example?
An example of the seasonal businesses when a company that works for wedding arrangements. Weddings usually have seasons, maybe summer or the winter. So the companies that benefits from the seasonal business, seasonal occasions could be like Target, any kind of thing, in Christmas or Thanksgiving. All those seasonal occasions can affect seasonal businesses, and vice versa.
Exactly. And then some countries, for tourism, they have tourism seasons. Okay, excellent. Okay, so preparing 3 sales forecasts. So when you're going to do a sales forecast, you can have 3 different ones. Pessimistic, which means things aren't going to go so well. Optimistic, kind of like the best case scenario. And then most likely, somewhere in between the pessimistic and the optimistic. And negative is another word for pessimistic. Like when somebody says you're being negative, often you're being pessimistic, which only means you're being conservative in financial terms.
Okay, so but what are the factors that determines the forecast for the cash? So what affects the forecast in order for it to be negative or positive?
Okay, so let's just back up one here. Okay, so let's go back to clothing. You're a clothing wholesaler, and the low forecast in sales. It could start with something like, what's the possibility that my order gets delivered much later than I expected and I run out of inventory? That could be a factor. What if I have HR issues where I'm understaffed and I miss sales opportunities? What's the probability of competition coming in and my sales get cut? Those kinds of things. So a lot of it could be pestle, or it could be internal, like HR. That could set up, a low estimate. And then an optimistic estimate is I find another supplier that can give me an even better price. I come up with some clothing designs that people really love. The economy really improves and people start spending more money and I make more sales, those kinds of things. Okay, so sales forecast for a startup. So here's an example. Okay, this is for a car dealership. So the number of cars in their trading zone, which means the number of cars in the area where they have a possibility of making a sale. Okay, and just say in a particular city, there's 84,000 cars. And the percent of those cars that are imports are 24%. So the number of imported cars in this business's city is 20,116. Number of imports in a trading zone times the expenditure on repairs. So he calculated the average repair for a vehicle, say in a year, is $485. Total import repair sales potential, $9.7 million. Okay, total import sales repair potential times, he thinks he can get a 9.9% market share. So he thinks if he opens his business, he's going to get about a 10% share of the market. So he thinks he can generate almost $1 million in sales. Okay, so this is a guy or lady thinking of opening a car repair business for imported cars, and this is how he went and did it. So he looked at the total market that's specific to his service, the average people spend a year on that service, to get the total amount in his city spent, which was 9.7 million, and then what he thinks he can get as a percent of the market share, which is about 10%, and therefore his sales estimate, that's the last number. Okay, cash receipts, forecast cash receipts. Record all cash receipts when the cash is actually received, not when the invoice is made or you enter it into accounts receivable. The cash method of accounting. Okay. Determine the collection pattern for credit sales, then add cash sales. Monitor closely slow and non-payers. So people who pay slowly, they're going to take your time for administration and you having to call or email them, and they can be a pain to work with. And then non-payers. So you have to figure out there's going to be a certain percentage of people who don't pay on time and a certain percent of people who are slow payers. So just as an example, in my marketing company, 3 years ago I had about 30 clients. And there was one construction company I worked with, and I would have to send them the invoice 2 or 3 times, and I would send it to the accountant. She would never respond, and I'd send it to the president, and then he'd say, email his accountant and ask her, did she get it? And he knows she got it. He's just playing it slow game to not pay me on time, because he's trying to manage his cash flow, but I'm trying to manage my cash flow. And so eventually I just made the policy, the second your invoice is due, I stop working until your invoice is paid. So he would send me emails to ask me to do certain tasks, and I would just, my only response was, your invoice is not paid yet, so I need to get that paid because I incur expenses in doing work for you, and I can't afford those expenses unless you pay your invoice. And that got his attention, so he started paying a little more on time. And you also had to be willing to lose that client, the client that you really don't like working with because he never pays you on time, because he might go and try to find somebody who he can take advantage of, which is not such a bad thing. You get rid of a client who hurts your business, or doesn't, well, hurts the management of your business, even though he pays eventually. Okay, probability of collecting receivables. So once you send an invoice, okay, 98.7% of invoices will be paid in the first month. If your invoice, your accounts receivable, becomes over 30 days old, there's a 93.2% chance that will be paid. If the invoice you sent to a customer enters into the second month, that's up to 90 days old, it's 85% likelihood it gets paid. And if the guy hasn't paid you by the end of 12 months, there's only a 28% chance he's ever going to pay you. So it's important to push on people to get them to pay on time, because the longer they take, the higher the chance they're never going to pay you. As you can see there at the 2-year-old invoices, I've never had an invoice go 2 years, but there's only a 12% chance. So for every 100 invoices that go 2 years old, only 12 of them get paid. Now, when we're talking about this, you always have the option of having a business model where customers have to pay you before the goods are received. And that's in business to business. So if you're going to do any business transactions, you can make it a policy. We don't do any work till you pay the invoice 100%. Okay, now it doesn't work in a restaurant, where it works perfectly in a restaurant because you take the payment, you make the order. But in higher end restaurants, when people pay after the meal, there's always a chance that people won't pay for the meal. But if you enforce a 100% payment up front before I sell you the goods, in business to business, you're going to have fewer customers, because a lot of competition use you can pay me 30 days later as a marketing tool. Okay. Collection of past due accounts. Entrepreneurs should regularly review late accounts receivable. Businesses should have a process for managing late receivables. Late receivables cost a business money, especially if the business is borrowing from the bank to cover temporary cash flow shortages. So if you have to borrow from the bank and the bank charges you, just say the bank's going to charge you 5% on your money. So on $1 million reals, 5% is 50,000 reals a year. And if you have to borrow this money from the bank, even though all your accounts receivables equal $1 million, when your customers pay you back and you collect your million, you still had to pay the bank 50,000 riyals to pay all your bills to keep your business going while you're waiting on your customers to pay the invoices. And that's the cost of not collecting right away. Companies can use bank products to speed up collections. So electronic payment collection. So instead of sending an invoice, waiting for somebody to write a check, put a check in the mail or give it to a courier and have it delivered to you, and that slows things down, you can do electronic. Remote deposit. Scan and deposit a customer's check payments. So say they give you a check. There's apps now on the phone where you scan the check and the money gets transferred to your account. Okay. Companies can use lawyers and professional collection agencies, if required, to collect outstanding receivables. Okay. Does anybody here have any experience, or have you discussed it in business law? What happens in Qatar if somebody, a customer doesn't pay their invoice, like a business-to-business transaction?
I think the first thing should be reporting them to the authorities.
Mm-hmm.
And then after that, they take it from there, or they follow procedure.
Okay. So in Canada and the United States is a bit different. There's no authority to call. Like you can't call the police or anything. You either sell it to a collection agency, or you have to go to the courthouse and file a claim in court. And if it's under 10,000 Canadian dollars, you file it in small claims court, which is a much faster process. And if it's over $10,000, you had to file it in provincial court, and then lawyers' fees kick in, and then sometimes it's not even worth it if it's like, say, $10,500. But small claims is an option to take somebody to court, but you need good documentation to prove that the money was owed to you. Okay, step 4, forecast cash disbursements. Record disbursements when you expect to pay them. Start with those disbursements that are fixed amount due at certain dates: rent, insurance, loan payments. Okay, and this is money you're paying out. It's a good practice to add a cushion to the estimate just in case. And by cushion they mean a certain percent extra. So assume your monthly cash outflow is 250,000 riyals. In your worksheet, put it at 270,000 riyals. Okay, just in case there's something that you didn't anticipate. If you don't know where to begin, try making a daily list of the items that generate cash and those that consume it, those that you spend the money on. Okay, cash flow concerns among small business owners. The number one concern is paying bills on time. Then tied is having enough cash to attract new customers and collecting accounts receivable. Meeting payroll and tracking cash flow. These are the main concerns of a business owner. Small business owner. Okay, estimate the end of month balance. Beginning cash balance, add your receipts, subtract your disbursements. End of month balance is what? What's the difference? Okay, so that's 37,000. The number is not in there, but that's 37,000 riyals minus 22,000 riyals. It's 13,000 riyals as your end of month balance. Okay. Line of credit, a bank line of credit. Many companies have an arrangement with a bank where they can borrow and repay money up to a certain limit. The line of credit acts like a credit card where the company can use the loan if needed, repay it as receivables are collected, and borrow again. A line of credit helps the company to manage short-term cash flow fluctuations. But there is a cost. The company must pay interest every time they use the line of credit. Okay, preparing a cash budget. So a summary of the 5-step process. Determine the minimum cash balance, forecast sales, forecast cash receipts, forecast cash disbursements, what you're spending your money on, estimate end of month cash balance. Okay, the benefits of cash management. Increase amount of speed and cash flowing into the company. Reduce the amount of speed of cash flowing out. Make the most efficient use of available cash. take advantage of money-saving opportunities such as cash discounts. So in accounting, do you remember net 32%? Did you do that in accounting? And sometimes N30, comma 2 or something like that?
You mean when we display everything, the expenses, the liabilities, everything, and then we have like a net income?
Yeah, well, it's a chapter in your accounting course on.
Yeah, like if you will pay within like 10 days, there is no interest profit.
Right. So, and sometimes they do it the other way. If you pay within 30 days, we'll give you a 2% discount. Right. So that means take advantage of money-saving opportunities such as cash discounts. So if you pay your invoice soon, the company will give you a discount. Or other kinds of discounts are if you make a larger order, you can get a lower price. But just be careful about those. Okay. Finance seasonal business needs. Okay. So you're in the wintertime or in the summertime, you might have different expenses, like electricity costs might go up in the summertime because you're running air conditioning more. Okay, benefits of cash management. Develop a sound borrowing and repayment system. Develop a sound borrowing program. Impress lenders and investors. So this is very good. If they see you're on top of your cash flow, it looks good. Provide funds for expansion and plan for investing surplus cash. So what are you going to do with that money? Are you going to invest it into the business, or are you going to put it in your pocket? The big three of cash management: accounts receivable, accounts payable, and inventory. Okay, accounts receivable. About 90% of industrial and wholesale sales are on credit. That means they don't pay up front. And 40% of retail sales are on account. Again, they don't pay up front. Oops. One second. Okay, survey of small companies across a variety of industries found that 77% extend credit to their customers. This is the American. Remember, a sale is not a sale until you collect the cash. Accounts receivable, so there's a difference in cash management and accounting. So accounting would call it an accounts receivable. But in cash management, it's not. Accounts receivables have a probability of getting paid. They didn't get paid until they actually are paid. Accounts receivable goal: collect your company's cash as fast as you can. Establish a firm credit granting policy. Okay, so if you're going to let somebody take their time paying, screen credit customers carefully. Develop a system of collecting accounts. Send invoices promptly. When an account becomes overdue, take action immediately. And now the action immediately could be a phone call, and you don't, take them to small claims court because they're a day late. That's just, add finance charges to overdue accounts. Check the law first. So when you do set up a credit policy, they have to understand first that if they're late, there's going to be a penalty. You just can't add the penalty after without telling them, because that's not the contract they entered into with you. Accelerating, speeding up accounts. Receivable collection. Ensure that accounts are accurate and timely. Include a description of the goods or services purchased. Ensure that invoices match purchase orders or contracts. Highlight the balance dues and due dates. Okay, this is when you're creating the invoice. Include contact information and case numbers in case customers have questions. Okay, that's on your invoice. And a statistic I read almost 20 years ago was that if you mail out an invoice or send them an invoice, invoices in color get paid faster than black and white invoices. That was just an interesting thing because they're easier to notice. Okay, accounts payable, beating the cash crisis. Stretch out payment times as long as possible without damaging your credit rating. So this is kind of funny because here we're learning collect as soon as possible but pay as late as possible. So if everybody followed these instructions, we'd all be trying to collect money from each other as fast as possible, and not paying each other as long as possible. But you're going to be smarter than all the other business owners, and you're going to get your money faster. Verify all invoices before paying them. There's a lot of people, criminals, email fake invoices hoping you pay them. Take advantage of cash discounts. Okay, so use of the cost of not using a cash discount. So $1,000 invoice, 210 net 30. So if you pay the invoice within 30 days, net within 30 days. Okay, so the amount due on day 0. So if you pay it within 10 days, so that 210, if you pay it within 10 days, you get a 2% discount. That's $20. Okay, and here's the formula below. Now you're not going to be doing math, but you need to know how this formula works, okay? So if you pay within 10 days, okay, that's $20 saved, divided by $980 times 20 days over 365, annualized interest cost. So if you always pay your every invoice like this, it's like making 37.25% on your money. So if you were always given this option and you always took advantage of paying your invoice within 10 days to get that 2% discount, a 2% discount over 10 days is a lot of money. It only looks like 2%, but really it's 37.25% if it was put out over a year. Now this is accounting, we're doing entrepreneurship, so just know the process. You don't have to do the formula, or you don't have to do the math of it. You might need to know the formula. Okay, beating a cash crisis, accounts payable. Negotiate the best possible terms with your suppliers. Be honest with creditor. Avoid the check is in the mail syndrome. Okay, you don't always be telling lies about where the check is. Schedule controllable cash disbursements to come due at different times. So don't make every piece of business you do, everybody wants money from you on a certain day of the month, because it could be difficult. And use your credit card wisely, okay? Be very careful when using credit cards. Beating the cash crisis. So inventory, monitor it closely. Inventory can drain a company's cash. Avoid inventory overbuying. It ties up valuable cash, and while you're holding the inventory, it has a 0 rate of return and actually takes up real estate, takes up part of your building which you're paying for, so it can be costly. Arrange for inventory deliveries at the latest possible date. So you're holding on to them the least amount of time. Negotiate quantity discounts with suppliers when possible. Okay, consider bartering. Exchange goods and services for other goods and services to conserve cash. So if you're doing business with a customer that needs your products and you need their products, consider just swapping inventory instead of swapping money. Okay, trim or reduce overhead costs. Ask for discounts and freebies, something for free. Periodically evaluate expenses. Lease rather than buy. So sometimes to reduce cash costs, renting a building is cheaper than buying the building. But if you end up being there for 30 years, you should have bought the building. So think about that in your formula or your equation of what decision you're going to make. Avoid non-essential cash outlays. So don't spend money on things that aren't essential. Negotiate fixed loan payments to match company cash flow. Okay, so if you owe all your payments, try to make sure, and this is when you're doing your budgeting too, that if the payments that you had to pay out are higher than your cash flow, talk to the people who you owe the money to, because they want you to be in business, because they want you as a customer, and maybe they're willing to help. Okay, trim overhead costs. So here's lots of opportunities. Buy used equipment. Hire part-time employees and freelancers. Outsource non-essential activities. Establish an internal security and control system. Develop a system to battle check fraud. So this is big in the United States, but people who write checks, and those checks, there's no money in the bank account. Change shipping terms. Use email rather than mail. Use credit cards for small purchases. Okay, start selling gift cards. So if it works in your business, in your retail business, for example. Switch to zero-based budgeting. Be on the lookout for employee theft. Keep your business plan current. Invest surplus cash. Build a cash cushion. A cash cushion means actually have extra cash on hand. Okay, conclusion. Cash is king. Cash and profits are not the same. Okay, profits take into account accounts payable. Accounts payable are not cash. Entrepreneurial success means operating a company lean and mean. Trim wasteful expenditures, invest surplus funds, plan and manage cash flow. And that is the end. So we have one more set to do. It's 10:11, so that was 40 minutes. Are there any questions? We'll take a break for 10 minutes, but are there any questions?
Not from my side, thank you.